Silver just did something commodities are not supposed to do. In the space of 48 hours, the market went from celebration to shock, and the numbers were so extreme that they looked like a typo. On January 30th, 2026, silver dropped more than 30% in a single session after printing a recent peak near $121 an ounce. That's the kind of intraday damage you expect from a collapsing startup stock, not a metal that underpins industrial supply chains and sits inside central bank conversations. And this wasn't a slow bleed that gave everyone time to rethink. It was a sudden mechanical air pocket. Bids vanished, liquidity thinned, and the selling didn't feel emotional. It felt mandatory. A cascade. The people who insisted this could never happen in silver were assuming the only forces that matter are mining supply and industrial demand. They were forgetting the third force, the one that dominates modern markets, the plumbing, margin rules, position limits, daily price bands, the invisible constraints that decide what can remain standing when volatility spikes. Here's the uncomfortable reality. Institutions already watch those constraints, like pilots watch their instruments. Most viewers don't, because the updates arrive as dry notices and technical tables, not as viral clips. But in a leveraged market, those notices are the story. When the constraints tighten at the same time positioning is stretched, price doesn't just move. It gaps. It snaps. It does things that look impossible right up until the moment they happen. So let me show you what the data actually says. Not the slogans, not the memes, not the angry arguments. The filings, the exchange changes, and the positioning snapshots that explain why this move was not random. Because once you see the pattern, you realize it's something else. The crash was the first act, not the conclusion. And silver's next move could shock everyone for the opposite reason. Welcome to Signal and Silver. This is the channel where we decode markets before they become headlines, using numbers, rule changes, and positioning instead of hot takes. If you like evidence-first analysis, keep this in your rotation the way you'd keep a wise elder close by. And comment where you're watching from. Because silver is a market, and the story looks different from Kathmandu than it does from New York or Shanghai. Now, what actually happened? Start with the timeline. Silver's surge into triple digits was already a warning that volatility was building, because metals rarely move that far that fast without leverage joining the party. As the rally intensified in late January 2026, risk managers didn't just watch price. They watched how quickly price was moving, because volatility determines margin. Then the squeeze and the plumbing began. The CME, the exchange group that hosts the dominant U.S. precious metals futures complex, raised margin requirements on gold and silver as volatility persisted. That kind of change is not a commentary on value. It is a reaction to risk. When margins rise, every leveraged participant must post more collateral per contract. If they can't, they reduce positions. And when many participants reduce positions at the same time, the market gets one-sided. Across the world, the Shanghai Gold Exchange issued its own announcement, with changes effective February 3rd, 2026. On the AG, T plus D contract, the margin ratio was adjusted from 26% to 23%, and the daily price limit was tightened from 25% to 22%. Those percentages are not trivia. A price limit is a hard boundary on how far a contract can move in a day before trading is constrained. Tighten it, and you compress the room the market has to breathe when it's already stressed. At the same time, attention exploded. Reports said social mentions of silver surged to roughly 20 times the 5-year average. That matters because attention is fuel for crowding. Crowding is fuel for leverage. Leverage is fuel for forced selling once the rules tighten. Then, on January 30th, the trap snapped shut. Prices plunged at a pace that made debate irrelevant because the market wasn't negotiating. It was liquidating. The central contradiction is this. If silver's story were simply demand disappeared, the decline would likely be slower and more orderly. Instead, the move looked like a margin-driven unwind, the kind that overshoots because it's about collateral constraints, not about patient revaluation. That's the difference between a market changing its mind and a market being forced to move. To see why this pattern matters, you have to look backward. Silver has a long history of being the metal where enthusiasm and structure collide. In 1980, silver became the emblem of a squeeze narrative. The market ran hard, and then the environment changed. Trading rules tightened, and the unwind was violent. The details were specific to that era, but the lesson endures. When a market becomes crowded and the rules shift, price action becomes discontinuous. In 2011, silver offered a cleaner modern example of the same dynamic. The rally accelerated, volatility rose, and margins were increased repeatedly. The result was not a gentle pullback. It was a sharp, exhausting decline that flushed out leverage. Afterward, the arguments sounded familiar. Some blamed speculative mania, some blamed structural unfairness, some claimed the move proved the rally was fake. But if you looked at the mechanics, the driver was clear. Higher collateral requirements and risk limits forced the marginal participant to sell. And in 2020, during the pandemic volatility shock, multiple commodities experienced dislocations, where paper pricing moved faster than physical logistics could respond. You saw spreads widen and delivery constraints appear, not because the commodity lost all usefulness overnight, but because the system that connects hedgers, speculators, warehouses, and transport routes was under stress. In many cases, after the forced flows ended, prices re-anchored to a calmer reflection of demand and supply. So the pattern is not mysterious. Step 1. A compelling narrative attracts participation. Step 2. Positioning becomes crowded, often on the long side. Step 3. Volatility rises, which triggers tighter constraints. Step 4. Leveraged participants become forced sellers. Step 5. The market overshoots, because liquidation is not a thoughtful process. It's a process of survival. Then step 6, the part most people miss. The next move is often driven by the players who were either hedged or liquid enough to act while others were trapped. That brings us to the institutional movement. Institutions are not one group. There are exchanges, brokers, hedge funds, commodity trading firms, producers, industrial users, and market makers. Each has different incentives, and they interact through the same plumbing. When the plumbing tightens, the players best prepared for tight pipes gain an edge. One striking example was reported from China. 6 billion renminbi, about $519 million during the rout. That single data point should change how you see the event. It shows that while the crowd was reacting, a sophisticated participant had enough size, enough structure, and enough discipline to capitalize on the mechanics. On the Western side, you have large vehicles that act as narrative magnets, especially ETFs. 10 as of February 6, 2026. It also means flows into and out of that wrapper can amplify moves, because the wrapper is how many participants express exposure without touching futures. You also have the futures market positioning itself. As of February 3, 2026, COMEX silver open interest stood at 409,694 contracts. In the same snapshot, non-commercial traders showed 214,508 long positions versus 48,904 short positions, with additional spread positions layered on top. The exact categories matter less than the shape of the distribution. A large speculative long presence can be fine when the market is calm. But in a volatility shock, it becomes the source of forced supply. When leverage meets tighter rules, those longs can become involuntary sellers. This is where coordination can appear without any secret meetings. Exchanges react to volatility, brokers react to margins, funds react to broker demands. Market makers react to one-sided flows by widening spreads. Everyone reacts to everyone else, and the result looks like a synchronized event because the incentives are synchronized. The timing is the coordination. Let's talk about the specific rules plainly. The exchange sets the minimum collateral rules and the contract specifications. Clearing members and brokers sit between traders and the exchange, and they can impose their own house margins that are higher than the exchange minimum, especially when volatility spikes. That means two traders can hold the same contract and face very different collateral demands depending on who clears their trades. In calm markets, that difference is background noise. In stressed markets, it becomes destiny. There are also systematic funds that follow trends and volatility signals. When a price move accelerates, many of these strategies increase exposure automatically, not because they believe, but because their models are designed to ride momentum. When the move reverses and volatility jumps, the same models can flip into risk-off mode, reducing exposure quickly. The buying is distributed over time. The selling becomes concentrated because risk rules trigger together. Now, bring that back to the numbers we actually have. The open interest figure is not just a statistic. 409,694 contracts means the market is crowded enough that small changes in behavior can have large effects. When non-commercial longs sit above 214,000 contracts, it tells you the speculative side had real weight. If even a fraction of that is forced to reduce simultaneously, the flow overwhelms normal bids. That's how a normal correction becomes a cliff. This is also why attention metrics matter. A 20-time spike in social chatter suggests a lot of marginal participants were arriving late, attracted by what looked like a runaway move. Late participation tends to be the most fragile participation because it often relies on leverage and lacks a plan for volatility. When the unwind begins, late participants sell first or are sold out by their brokers. Their exit accelerates the very move they fear. So the institutional movement is not just about one headline name. It's about who had the flexibility to keep acting while others were trapped. A player positioned with options, spreads, or diversified collateral can survive the margin hike. A player who is all in on one directional futures bet cannot. A player who has multiple clearing relationships can shift exposure. A player who doesn't cannot. This is how the same market creates two different experiences at the same time, one of opportunity and one of forced retreat. That brings us to the dislocation and even sharper focus. When leverage unwinds, paper pricing can temporarily trade like a distress asset. But silver is also an input for real production. Solar manufacturers, electronic supply chains, and industrial fabricators don't stop needing silver because a futures chart is ugly. They may delay purchases, they may draw down inventory, they may renegotiate contracts, but they do not cancel the physical reality overnight. That's why the paper move can overshoot. In dislocation moments, the question isn't who is right, the paper market or the physical world. A forced unwind sets the price until it finishes. After that, the market has to reconcile. Either physical demand steps back enough to justify the lower price, or the lower price reawakens demand and constrains supply, pulling price back toward equilibrium. The path is not guaranteed, but the mechanism is reliable. There's another dislocation that hides in plain sight: the difference between owning exposure and owning metal. An ETF share is exposure. A futures contract is exposure. A bar in a vault is metal. These are connected, but under stress, they behave differently. Exposure can be sold instantly. Metal moves slower. When fear hits, exposure can be dumped far faster than metal can be transported, assayed, and delivered into industrial use. That speed difference is why paper moves can look insane compared with the physical world. And that's why the next move can shock everyone. After a liquidation, the market often becomes thin. Many participants are gone, either by choice or by force. In a thin market, it takes less buying to move price. If the forced sellers are finished, even modest demand can create sharp rebounds. But broken narratives can coexist with functioning fundamentals. Put the pieces together, and the event stops looking like a mystery. A crowded trade met tightening constraints. Attention met leverage. Volatility met margin. And when those collide, the result is a fast, ugly unwind that overshoots what fundamentals alone would justify in a calm environment. That overshoot is the trap. It punishes late enthusiasm on the way up and late panic on the way down. The deeper lesson is that silver can be both a real asset and a financial instrument at the same time. As a real asset, it lives in supply chains. As a financial instrument, it lives in risk limits and collateral tables. When the financial side dominates, the real side looks irrelevant for a moment. It never died. The market's constraints just changed who was setting the price. Now we get to the dislocation, the part no one is discussing clearly enough. Two sets of signals were speaking at the same time, and they sounded like opposite stories. In the leveraged paper market, price collapsed as forced selling dominated. But in the broader ecosystem of silver exposure, the scale of holdings and the surge in attention suggested the underlying interest in silver as an asset had not simply vanished. Paper markets and physical realities don't always move in lockstep, especially during stress. A futures price can fall faster than physical demand changes, because futures are about marginal flow at the edge of leverage. Physical markets are about logistics, fabrication, and multi-month contracts. When a futures collapse is driven by forced selling, it can create a temporary discount that looks like silver is dead, even while the underlying industrial consumption and longer-term hedging demand are still operating. So let's lay down the evidence with numbers, because numbers are the only way to keep this grounded. Start with open interest: 409,694 comic silver contracts as of February 3rd of 2026. That's the size of the field. Now look at positioning. Non-commercial longs at 214, 508 versus non-commercial shorts at 48,904. Even allowing for spreads, you can see the imbalance. This matters because in a crowded long trade, the marginal seller in a stress event is often the same person who was the marginal buyer in the run-up. Next, look at the rule environment. On the CME side, margin requirements were raised amid volatility. On the Shanghai Gold Exchange side, the AG T+D margin ratio was set to shift from 26% to 23%, while the price limit moved from 25% to 22%, effective February 3rd, 2026. Notice the duality. One venue tightens risk by demanding more collateral. Another tightens the corridor for daily movement. Different choices, similar effect. Less breathing room for stressed positions. Now look at the attention data. Social mentions surging to around 20 times the 5-year average. Tells you participation pressure was rising. Attention is not positioning, but it correlates with it in modern markets. The more people watch and talk about a trade, the more likely it is that leverage, options, and trend-following capital have already piled in. That creates the conditions for a flush. And now look at the scale of the paper-silver interface. An ETF holding over 520 million ounces is a signal that enormous capital is using financial products to hold silver exposure. This matters because the story of silver is not just about mines and refineries. It's about the vehicles through which capital expresses its view and the constraints those vehicles face under volatility. So what does this mean going forward without turning this into a prediction? Historically, when you get a leverage-driven collapse in a crowded market, the next phase depends on whether the forced flows are done. If the forced flows are not done, rallies get sold and volatility remains high. If the forced flows are largely done, the market often shifts into a quieter phase where price begins to reflect fundamentals again, and where the biggest players start building positions with less noise. There are a few scenarios that tend to follow this kind of event. In a conservative scenario, silver continues to chop lower and sideways as open interest and speculative length bleed off, with occasional sharp rallies that fail as risk managers keep limits tight. In a moderate scenario, the market stabilizes once liquidation exhausts itself, and price re-anchors as participants rebuild positions more carefully, watching margin and volatility like hawks. In a more aggressive scenario, a renewed squeeze narrative can reappear after the cleanup, precisely because the cleanup removed the most fragile participants. The indicators to watch are not mystical. Watch open interest, watch how non-commercial positioning changes in the next CFTC snapshots, watch exchange margin announcements and price limit changes, watch whether ETF holdings and flows stabilize or swing, and watch volatility itself, because volatility is the tax that leverage pays. This brings us to the divide. The people who get hurt most in moves like this are not necessarily the least intelligent. They are often the most certain. Certainty leads to leverage. Leverage leads to fragility. And fragility is punished when the rules tighten. They are the ones who understand that in modern markets, the plumbing matters as much as the story. They track margin changes like weather. They treat price limits like road signs, not like optional suggestions. If you take one lesson from this silver event, let it be this: the market is not just a price. It is a system, and systems behave differently under stress. It is a message that the system hit a constraint. This is signal in silver, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, you know what to do. And the question isn't whether the next phase unfolds. The question is whether you'll recognize the mechanics early enough to understand what the chart is really saying when it moves.